Could be a growing liquidity crunch in the banking sector, meaning banks are strapped for cash on hand, struggling to meet financial obligations and stay in business. This problem has been showing up in the repo market, where banks post collateral to receive cash as an overnight agreement. The banks have been increasingly tapping into this market for cash over the past several weeks, creating a growing concern amongst investors. The repo market then blew out on Friday, October 31st, to over $50 billion, sending even more concern amongst financial observers. This spike in the repo market coincides to a large decrease in bank reserves, where there is a possibility, because of that spike in repo usage, that these reserves are too low to support short-term liquidity needs. This level is now actually trading at $2.8 trillion, which some analysts think are too low and could cause a problem in the sector. The Federal Reserve has been shrinking their balance sheet down from almost 9 trillion down to around 6.5 trillion, adding to the drawdown in liquidity of the banking sector. The Fed may have shrank their balance sheet too much, too quickly, helping to create this liquidity crunch. This will affect the weaker banks in particular, making it difficult for them to survive. Also, the Fed is taking some action recently, ending their balance sheet runoff on December 1st, which was announced on Wednesday. So any maturing securities will be replaced by buying new ones, stopping the decline in the balance sheet. This problem has happened in September of 2019, where the repo market surged even higher. This demand for cash sent the overnight repo rate skyrocketing to 7%. The Fed had to intervene and start purchasing tens of billions of dollars of securities, re-expanding the Fed balance sheet in order to get this rate lower. Once stabilized, the Fed then started a monthly purchase program of securities at a rate of $60 billion per month. The Fed could execute the same strategy again if the repo spike happens to get worse and the Fed loses control over short-term interest rates. In 2019, the last time this repo market got overused, did not cause a meaningful impact on the gold market despite the expansion of the Fed's balance sheet. Gold simply kept consolidating for several months after a run-up. It did eventually break to the upside of this consolidation to print even higher prices. Gold is also in a consolidation right now, and it doesn't look like the Wednesday decision by the Fed to stop the balance sheet runoff has had any meaningful impact on the gold market, at least so far. I do think that gold is in a bull market and will continue to consolidate until it is ready to march higher once again, with perhaps a dovish Fed adding a boost to the gold price. That's it for now. Thanks for watching, and we'll see you in the next one.